Greetings and welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor with wealthmanagement.com's RPA Edge. I review all of the industry stories and I pick out the 5 most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story is Fidelity announced at the recent QPA Fiduciary Summit that they will now be offering, or soon be offering, digital assets to 401k plan participants. This comes on the heel of scathing statements by the Department of Labor about this asset class. Many are questioning their process and whether they should be taking such a strong stance. A recent comment by David Gray at Fidelity's head of workplace products and solutions said, "We believe retirement investors increasingly view digital assets and Bitcoin in particular as an investment worthy of consideration for long-term investments." Last year, Vanguard's chief economist wrote, "There is no enduring economic or investment rationale to expect cryptocurrencies to generate positive real returns." So polar opposites there from Vanguard and Fidelity. And at that same event, QPA Fiduciary Summit, Fred Barstein, noted ERISA attorney, said to be ready to be investigated by the DOL if you do offer cryptocurrency, with the recommendation, don't do it. Second story is a DeVoe report showing that the number of RIA M&A deals has reached its highest point ever, led by smaller and especially mid-size $500 million to $1 billion firms. Consolidators accounted for 50% of the deals, led by Beacon Point, Creative Planning, and Mercer Advisors. A temporary slowdown is expected due to the war in Ukraine and inflation, maybe rising interest rates. But overall, DeVoe predicts that there's going to be increased activity, will continue in order to achieve scale and because of the lack of succession planning. We're expecting similar results in the RPA market, which is a little bit behind and much smaller than the RIA market, but for same reasons, succession planning and scale. But we're not seeing, and we're seeing that some of these DC aggregators, RPA aggregators, foray and start buying RIA firms, which could further heat up that RIA market. We're not seeing so much the other way, although the creative planning locked-in deal could reverse that trend. Third story is that P&I is reporting an 18.2% annual increase in assets by DC Recordkeepers, with $9.7 trillion overall, and that compares to the ICI total number last Q3 of 2021 of $10.4 trillion, so it's a pretty representative sample. But the increase in participants, it's only 4.1% at 109.1 million. There's still very thin margins, which are fueling consolidation, especially as fees transition from asset-based, because a lot of the increase was based on the increased market, as well as litigation, with more than 200 lawsuits in the last 2 years, most citing high record-keeping fees. Notably, the Fab 5 record keepers work in all markets from micro to mega, and it's hard to compete if you don't. Many of them are looking to expand revenue opportunities as the record keeping fees decline, with rollovers, wealth management, and worksite benefits. The P&I article predicted that fees are going to continue to decline, and the question is, how low can we go? Seems lower is the answer. Fourth story is Edelman Financial Engines with $294 billion under management, mostly in their managed account program, and 1.3 million clients, is partnering with George Washington University's Global Financial Literacy Center to offer counseling to participants and access to education. GW is currently working with a 30,000 employee plan. Three-step process includes an initial assessment, personalized counseling, and then an impact assessment. Still 2 questions to be answered about financial wellness. Number 1, engagement. We haven't really seen much in the way of engagement. And secondly, where's the money? No one has figured out how to make money from financial wellness and even personalized counseling. But with M&A, with managed account fees coming down, this just may be a way for financial engines to maintain their current price point. And then the 5th story is a Schwab study called Retirement Reimagined. Surveyed the different ways that generations save, particularly focused on millennials, who are the largest group of workers now at the workforce. Millennials spend less time planning, but they save more. Baby boomers think in terms of wealth accumulation and target date, whereas millennials think lifestyle. Maybe we should be having target date lifestyle funds. And then interestingly, 24% of millennials are interested in investing in cryptocurrency. So maybe Fidelity is onto something. So before I end, I did want to note a recent passing of John Carl, founder and president of the Retirement Learning Center. John made great contributions to the DC industry as an industry executive and then entrepreneur. And he personally helped me launch the CKP program with UCLA. John died last Saturday, April 23rd, at 54 years old, leaving his wife and 2 young sons. So those were the 5 most interesting and important stories from last week. I listed 5 additional stories I thought were worth reading. Please let me know if I missed anything or if you have any comments. Otherwise, I look forward to speaking to you next week on 401k Real Talk, which is now on wealthmanagement.com's RPA Edge.